everybody. Welcome to another 30-minute Thursday. My name is Mike Sears, president of Sears Wealth Management and Insurance Solutions, and with me today is Seth Morris. Welcome, Seth. Glad to have you with us today.
Thanks, Mike. I'm glad to be here with you today and glad you're back with us.
Yeah, I was on the ski slopes last week, and I didn't hurt myself, so that was really great.
Yeah, well, we're happy about that, and welcome back again.
Well, thank you very much. So, Seth, you want to announce our topic for the day today?
Yeah, our topic today is, are your assets diversified? And like always, if you'd like to ask questions or comment, please use the comment feature, and we'll try to get to those as best we can, but we hope you enjoy our broadcast today.
Great. Thank you very much. This is really a great topic, and I'm going to go to a quick disclosure slide. Basically, this slide says that there's no recommendation for you to buy. There's nothing for us to sell. Investment has risk to it, and of course, whenever you decide to do something about your financial situation, make certain that you also see your accountant and understand the taxes and all the ramifications of the decisions that you make. So with that, why don't we go to our next slide? Here's the question, Seth, which I love. Does your portfolio look like this? Or does it look more like this? Seth, what do you think about that?
Yeah, you know what? I think we see both, right? The first one, there's a lot of variety. The second one it's just bananas. I think we see a lot of portfolios. We see some people who even think that their assets are diversified and there's a lot of variety, but it's really just a bunch of bananas. And so how do we know if our portfolio is diversified or not really is the question, and we need to take a deep look and see what we can do to diversify better.
Yep, and that's, I think, the whole purpose of what we'll talk about today. So why diversify? The goal of diversification is not necessarily to boost performance, because it won't ensure gains or guarantee against losses. Diversification does, however, have the potential to improve returns for whatever level of risk you choose to target. So that's the goal. It has the potential to improve returns. And so let's dig into this a little bit further. Seth, why don't you take this one?
Yeah, so it says, what is a diversified portfolio? A diversified portfolio may include stocks, bonds, cash, and other asset classes whose returns haven't historically moved in the same direction. So we want to have non-correlated assets. If a portion of our portfolio is declining, we'd like for the rest of our portfolio to be growing, or at least not declining as much. And just as important as investing across different asset classes, we want to diversify within asset classes, and we're going to get into that in more detail here.
Okay, great. And I think that's the goal. I mean, wouldn't that be beautiful if in every portfolio that was designed that there were some assets that could really be a hedge against loss, wherever it could be in a down market, and other assets have the ability to increase in value, right?
Mm-hmm.
That would be amazing. This next slide kind of teaches us a little bit about diversification, and as you'll see, that diversification has helped limit losses and also capture gains through financial crisis and recovery. And so this slide is talking about from January 2008 to February 2009, which for most people was probably the worst period of time in the marketplace. Losses were very, very substantial. And so the first measurement is from those two time periods, 08 to 09, and through the entire downturn to the market bottom. You can see the light blue color is the diversified portfolio, and the darker blue color is the all stock portfolio. Of course, green is cash. So, Seth, what do you see in that period of time when the market is really down?
Well, we can see here that this light blue diversified portfolio it's down, right? But it's not down as much as this all stock portfolio.
Okay.
Mhm.
And so when we look between the periods of March 2009 to February 2014, and this is from the bottom of the market through the recovery, what do you see now happening?
Well, the all stock portfolio performed much better than the diversified portfolio, right?
Okay. And of course that would make sense, right? The
Hmm.
diversified portfolio was really designed to um, limit losses, and but because it's not all stock, during the recovery period of time, probably won't see as much gains either, right?
Yeah, some people will say, well, one of the downfalls of a diversified portfolio is that you're going to miss out on some gains, right?
Yep.
Well, we can see from this chart here, yeah, you missed out on gains, but you also missed out on losses. And so when we jump to the right and we see, a full snapshot of January '08 to February 14, we kind of end up in the same spot. Obviously, I'm trying to see, yeah, the all stock portfolio performed a little bit better, but we didn't incur all those losses and we didn't, participate in all the gains, but we ended up kind of in the same place.
And of course, this is also assuming that during this period of time, we're not taking any income out of those assets at all, right? So the picture on the left from '08 to '09 would be even a different picture if during that time period an investor needed to take income out of that portfolio. Can you imagine having a 30 to 50% downturn in the market, and at the very same time you're forced to have to take income out monthly to maintain your standard of living? And you destroying the portfolio probably isn't the right word to use, but you would see losses that would increase dramatically if during a time period where the market is down, you're having to take significant amounts of income out of that portfolio, right?
Oh, yeah, definitely. You always hear people will say, well, it's only a loss if you sell it, right? Well, if that's your source for income and it's down, you have to sell it. So you have to incur a loss just to maintain your standard of living, like you said. And I like this chart because it goes to show, there's a principle. If you lose 50% of your portfolio, well, you have to have 100% return to get back to where you were before you lost anything.
That's
And so you
right.
can see, even though you had all these gains from the all stock portfolio, you end up about the same as the diversified portfolio because we didn't take on all the losses.
That's right. So hopefully this is really a helpful slide. So we're talking about, again, diversification helps limit losses and and can still capture gains, and won't be as much as if it was all stock, but that's one of the benefits of diversification.
Hmm.
Seth, why don't you take this slide?
Yeah. So just some other things when we're talking about diversification. We want to be aware of over concentration in a single investment. We want to diversify across stocks by market cap. So we want our small, mid cap, large cap. We want to diversify across sectors and across geography. Um, and we want to also consider a mix of different styles. We want growth and value stocks. We'll talk about emerging markets, developed markets, different things like that.
I think that the top bullet point is something very significant. Beware of overconcentration in a single investment. It
Mm-hmm.
is so easy, and we're going to talk about this in a second, but it is so easy to see something that looks so enticing that you want to put a large percentage of your money in that one single investment because you think or you hear that this is going to solve all your problems financially. That's very dangerous to do that. So beware of that. Um, and that's what we're talking about here. Diversification across all asset classes is has a much greater likelihood of helping you achieve your goals. Of course, and we can't talk about this too much, it's not just about diversifying the asset classes, but it's diversifying the asset classes within a financial plan that is set in motion to achieve your financial goals, putting those all together. And we'll talk about this at the end when we talk about purpose of assets. But
yeah, and real quick, Mike, before we move on here, the second bullet as well, diversify across market cap. You'll have some people that say, well, I'm invested in the S&P 500, so my assets are diversified. There's 500 different companies there. Well, you've also got 500 large cap companies. And there's a book I read some years ago, and it was talking about if you were diversifying and you likened it to making a salsa. And you said, well, we want all these different ingredients. And someone came and they said, I've got 500 tomatoes for the salsa. Well, that's what it's like when you invest in the S&P 500. You got 500 tomatoes. And so investing against among those different market caps really is essential for a diversified portfolio.
Yeah. Of course, if we add on to that same topic, it might not be uncommon for someone to have, let's say, 4 or 5 different mutual funds, and the person would ask, well, I think I'm diversified. I have 4 different funds. And then, of course, we start looking at statements and we realize that we have a lot of the same companies in the same funds. And so the question begs, are we really fully diversified? And the answer is probably not so much. And so we have to not only look at, just because we have different managers doesn't always mean that we are fully diversified in our portfolios.
Mm-hmm.
Beware of chasing returns in a single asset class. That's what we were just talking about just a minute ago. And so this next slide, I think we'll have some fun with, that will teach this principle. And let's look at that. This slide here is what we call a skittle chart, really. It's got all these different colors, but it has all the various different asset classes that, Seth, you were talking about earlier. Large cap value, mid cap value, small cap value, large cap growth, mid cap growth, real estate, high yield, intermediate term bonds, short term bonds, foreign stocks, and commodities. And so this, because it's a PDF, I can't kind of click through it, but you'll notice here, if I can kind of highlight a couple of things. Let's just suppose, for our purposes, you decided that you fell in love with the color gray. It doesn't really matter what the asset class is at this point, but let's suppose you said that you were falling in love with the color gray. The news was telling you love gray. Your friends were telling you to buy gray, and so you buy it. And of course, this chart is from 97 to 216, but the principles are all the same. So in 97, you decide, hey, I'm going to go buy gray. And so you do. In the next year, where is it? It's right here at the bottom. Mm-hmm. You say, well, that's impossible. Everyone told me I should love gray. So you say, I'm not selling that thing. So you hold onto it for another year, only to find out that gray is right at the bottom again for another year in a row. And you say, well, I don't know. I guess I must be wrong. So you sell it, only the next year to find out that gray is about 2/3 the way up the chart. And you say, wow, that's amazing. And so you say, well, I'm not buying it yet. And so you say, and then all of a sudden you find out in the next year that gray is right at the top. And you said, see, I should have held on to gray, right, Seth?
Mm-hmm.
So you buy gray only to find out that gray is coming all the way back down. And then it goes all the way back up. And then it goes all the way back down. And this is what happens when we start chasing returns. It's a never-ending battle. And so if you look at the different colors in this chart, you ask yourself, is there any pattern in this chart? And Seth, there is one pattern in the chart. And so Seth, why don't you talk about that?
And, we can see there's already, this green line hitting all of the diversified portfolios throughout the years. And we can see that it stays pretty steady in the middle. It's never the best and it's never the worst, right? But we're always within, a few spots of the middle, right?
Yep. And in this example, all they did was they took an equal weighting in all the asset classes. I mean, you think about it, just in terms of even just averages, you would think, I mean, you would just, just mathematically, you would think that if you took an average of all the asset classes, if you had $100,000 and you put 10,000 in each, you would think that you would be somewhere probably in the middle, and that's about where you're at. And how many times do we talk about this, Seth? What's the philosophy? If we can we don't need to hit home runs here. If we can hit singles and doubles and not blow it up, that's the goal, right?
Mhm.
Steady Eddie wins the race, and that's the goal really of a diversified portfolio.
Yeah, and looking at this chart, someone could say, they could look at the bottom and there's this 20-year annualized return, and they could say, well, hey, a diversified portfolio did 7.5% in this time period, and mid-cap value did 10.5%. So why don't I just get into mid-cap value and hang on to it, right? But the issue is most of us are not disciplined enough to do that in the first place. You end up with investor dyslexia, right, Mike, where you end up selling low and buying high, chasing returns. And also, this is a 20-year snapshot. Do you think the next 20 years are going to be like the last 20 years? And so that diversified portfolio, that steady Eddie, that never the best, never the worst, mitigate against some downside risk, that's our best real, chance of success going forward.
Love that. Thank you. So let's talk about this. Let's talk about another way of thinking about diversification. And so far, we've been just focusing on the yellow box, which is asset diversification, right? Looking at all the different asset classes, large cap value, et cetera. That's what we've been talking about. But there's another way to look at diversification, and that is, one is purpose. See, because every asset that you own should have a purpose. And what are the normal purposes that we see in a financial plan? The first purpose that we see, and by the way, they're not necessarily in any order, but emergency cash needs is a purpose. And so if that is an important purpose, and I want to say to you that it really is, because nothing happens unless we have cash, right? When we have an emergency, we need to have cash. Well, we would like to tie the investment or the asset class to that purpose, to that need. Another purpose is income. What kind of income? We need reliable, consistent income. That would tell us that the investment that we're using for that purpose would be different. Why? Because we need it for income. Would we invest money in a portfolio that we just needed income from into some very high risk portfolio? Probably not, right? We also have another purpose, could be supplemental income needs. Those are income needs that come. I like to say it this way: what are those things that require money and planning to achieve? They're not our normal income stream that we need monthly, but they come from time to time. So we've got another asset class that we're investing in just for those supplemental income needs. Another is liquidity. We can never have enough liquidity. And that final purpose is growth. And wouldn't it be wonderful if we had some assets in our portfolio that were just designed specifically, not for income, not for emergency cash needs, but simply for growth long term? Might be a legacy asset that we're going to give to our kids. And so purpose in our diversification strategy is very, very important.
Yeah, I think purpose is huge, Mike. And you could have a very well diversified portfolio, but it would never be the type of portfolio that you'd want to take income from on a regular basis necessarily. And so understanding these different purposes for funds and assets, and then being able to diversify those individual assets is really key in a financial plan, right?
And I think you said it best. Usually, if there is not a financial plan, all we are dealing with is asset classes. It's just money. And the thing that turns everything really beautiful in retirement is taking those assets that you have acquired over a lifetime and putting them together in a financial plan that is based on your goals for the future, and then mapping that out for the next 10, 20 years of your life. Now we can tie all these pieces together.
Yeah. Just touching on this again, sorry, but this purpose is really so key. If someone comes and they says, I want a diversified investment. Okay, well, when do we foresee taking money from this investment? Oh, well, it could be 30 years and it could be tomorrow. Those are very different time frames. And so really knowing what your goals are, knowing what the purpose is really helps guide that investment, in a big way.
Yeah, thank you.
Yeah.
And then, of course, the last diversification issue that we really need to consider, probably now more than ever, is the tax consideration of the way that our assets are invested, right? And if we had time, and we've talked about this in the past, that assets, investments are categorized between taxable. This is the taxable investments are those they're taxable every year, whether you use the income or not from them. You have tax deferred assets, which is pretty much where most of the money is in the United States. Retirement accounts are tax deferred, but they're all taxable when you take the money out. And then we have tax-free assets. And of course, if we all had a choice, we'd all just double down and get it all into tax-free. And there isn't time to talk about how we get there today. But so when we're talking about diversification, we're talking about diversifying by asset class, by purpose, and also by taxes. And so we're almost out of time here, but we're gonna talk about the key takeaways. And Seth, why don't you take the first one?
Yeah, the first takeaway is, diversification has the potential to improve returns for whatever level of risk you choose to target.
Love that. A diversified portfolio may include stocks, bonds, cash, or others whose returns haven't historically moved in the same direction. We talked about that.
Mm-hmm. It also may help limit losses and capture gains through a financial crisis and during recovery.
And also diverse across stocks by market capitalization, small, mid-cap, large cap sectors, and also geography.
Yeah, the next takeaway is we don't chase returns.
If you chase the hot stock, you may get what?
You may get burned, right?
You may get burned. Yeah, that's right. And then finally, diversification is not limited to asset classes alone, but may, and I'd like to change that and say probably really should include having a purpose for every investment that we have, and also taking into consideration tax needs.
Yeah.
So Seth, is there anything else you'd like to share to wrap this thing up today?
No, diversification is, it's very important. If you're wondering if your portfolio is lacking diversification, reach out to us. We can help you take a look.
That's great. Thank you.
Yeah. And I think we have a raffle winner today, Mike, right?
Yes, we do. And the raffle winner is
Seth Morris. I love it. Thanks, Mike. Just kidding.
Give that back to me. And I think that it's Linda M is the raffle winner for today. And so we're just thrilled that you will. What is the oh yeah, so it's a $25 gift card to your favorite place that you would like to go to. And so Linda, we're very thrilled that you've won. And thank you very much. Thank you all for joining us today. We're delighted to have been with you. Signing off here from Rancho Cucamonga, California, and have a wonderful rest of the day.